Morning, everyone. Sorry, that's probably a bit loud. And welcome back. Thank you for coming back. So over the next 40 minutes or so, we're going to try and explore, hopefully give some solutions to the big issues for the resi investment and BTR sector. So what's really happening out there and how the sector can cope with high inflation, recession, austerity. We've heard this morning already, increased building safety costs, high interest rates, and potential rent control. So not really very much to deal with. But let's try and find some solutions. We've got a fantastic panel for you to provide some insight. As Brendan said, I'm Jason Hardman. I look after the living sector valuation teams at CBRE. I've got a cross-section from the sector for the panel today in terms of a broker, a landlord, a developer, manager. So these are the people who are properly doing the doing and are right at the epicenter of the sector. So we're going to try and explore three things as I said, over the next just under 40 minutes, because I'm speaking too long already. So what's happening out there, what to expect kind of in the near term, and what their thoughts are, particularly from a financial perspective, but also from an operations perspective, in terms of the steps that market participants, such as investors, lenders, can take to help navigate some of those sort of headwinds over the near term, or 2 years, if we're to believe the Bank of England. So audience participation is to be actively encouraged. I will be asking some questions, but I will encourage the audience, please, to stick your hands up. We do have some roving mics. But first off, I'm going to let the panel give a brief introduction for themselves. So we'll go from my left with Thomas, then Michael, and then Polly. Thank you.
Thank you, Jason. Good morning. I'm Thomas Grounds. I'm Granger's head of research. So I cover our city strategy, which is where we invest. I work across our business with many of our teams, particularly our marketing team, on our extensive consumer research program. And of course, last but not least, I advise the business on ever-changing macroeconomic issues, which keeps me in business.
Hi, everyone. My name is Michael Harrington. I am with Related Argent as our Director of Operations. I moved here in April, and prior to that, for the last 17 years, I oversaw our BTR operations in Boston, Chicago, and New York. Related Argent is opening our first site in King's Cross in September of next year, and we are hopeful that it will open in smoother economic waters than what we're experiencing today. Polly gets my mic.
Oh, no, mine's working.
Hey, it's working.
It's working, yeah.
All right.
Hi, I'm Polly Simpson, Head of Multifamily Development at Savills Operational Capital Markets. I spend my day job brokering forward funding transactions on behalf of developers and investors. It's securing delivery or investment into the build-to-rent space. I've been doing that for 10 years and had the privilege to advise on over 50,000 build-to-rent units so far to date.
Brilliant. Thank you. Thank you very much. So, no surprises. CBRE passing it over to Savills for the first question to say, right, so Polly, okay, so what I'm seeing across other sectors, commercial real estate is down over 4 months, about 10+%, okay? And that seems to be accelerating. Every time I look on social media, on LinkedIn, BTR seems to be really, really positive. Can you just give us a snapshot, please, of what you are seeing is happening out there? Who's out, who's in, what's happening with transactions?
Yeah, so, I mean, 2021 was a record-breaking year for capital deployed into the sector, so broadly £4.3 billion worth of capital. Focused on delivering build-to-rent. 75% of that money was spent in the development stages, and 2022 is set to beat that record. At the end of Q3, capital deployment and investment was up 49% on the same time in 2021, which is hugely positive. Now, that was spurred on by a record-breaking quarter in Q1, but that hasn't dissipated over the course of the year. And Q2 this year and 3 have seen, again, record-breaking levels of investment. Q4, I think that post mini budget, we've definitely seen a bit more of a slowdown. But I mean, we've already closed on £500 million worth of investment in October, and so I do think that we've got all the scope to go out to beat 2021 by a margin. Now, I understand in the kind of context and backdrop of political and economic uncertainty, that does sound like quite a big claim. But the resilience of the sector during COVID certainly hasn't put off investment so far, and arguably the fundamentals of why you would invest into this space have only grown over the course of the last 6 weeks and 2 months as mortgage product availability helping first-time buyers becomes more constrained. And talking about who's in and who's out, well, you know, there is a lot of the mainstream investors into the space are still very much committed to deployment in the sector. And it's probably best for me to ask our 2 investors on stage as to what their strategy is.
Yeah, nicely handed over. So that's brilliant. Thank you very much, Polly. So, Thomas, let's hear the Granger take.
Indeed. So just to say, we've got our own results out in 2 days. So if I get hit by a lightning bolt, you are seeing the awesome power of our investor relations.
I hope you're still in the job on Friday.
yeah. Granger's still in the market. We are still acquisitive, and I'll talk about this in a minute. We still very much believe in the sector because it's our sector. Clearly, there's a lot of volatility in capital markets. As an investor, you have to deliver risk and return commensurate with what you told your investors are going to get. So I think what we're going to see in the next 3 to 6 months is you're going to have a little bit of standoffishness. You may see transaction volumes not be in build to rent, not be quite where they were, and that goes for the wider housing market as well. But we also, when we think about capital markets, we have to go to what really matters, which is the underlying fundamentals. And this is where I want to kind of stress the difference between build to rent and commercial property. Our rents are growing. Build to rent sector's growing. The wider residential sector rents are growing. We don't have enough supply. And over the long term, this sector has delivered a rental growth pretty much in line of CPI. Dropped off a bit recently because inflation's been so high. That is very different to commercial. So when people try and drop us in with commercial, it's worth remembering, commercial rents don't grow, really, over the long term. Some people don't like saying that, but over long term, they haven't really grown. So when a nominal gilt goes up in yield, that means there is pressure on commercial property. But it's slightly different for residential because we do actually grow our rents over the long term. And index-linked gilts, I think, are about minus 0.5. They're RPI linked, but there is a big difference, and I think it's important to remember that difference in our sector.
Thanks. I'm going to come back to, I'm not going to ask the yield question yet. I'm going to hope that somebody from the audience is going to ask that, so I don't have to ask it. But Michael, can I just come to you? So you're new over.
Yes.
In terms of the last 6 weeks, in particular, I mean, give it obviously significant political storm, if nothing else. What's the impact been on your plans in terms of your pipeline, King's Cross, Tottenham Hale, etc.?
Yeah, great question. I think for me, the first thing I've had to over the last few weeks explain is the relevance of the head of lettuce. I think that was a great thing that got put out there, and it struggled for my American colleagues to really understand it. But that was kind of an amusing part that kind of really highlighted the kind of challenging times that we're in right now. When we get a little bit more serious and apply it towards how we're looking at for our outcome in future, our King's Cross estate is set and locked and ready to go. That's definitely going to be opening up in September of next year. With what we've got for Brent Cross as well, funding's been secured for that. And as we look out for our other future deals, we are now showing that track and record. So what we really want to kind of get at is, yes, it's challenging right now, but look ahead. Think about this. For those of us that have been in the business a while and recognize these ups and downs, there's this kind of initial phase of, oh, fudge, this is really challenging. But if you think beyond that and kind of really go back to what Thomas was saying, the fundamentals can be there, and you've got the kind of right parts to really weather this through, depending on how you react at the time.
Thank you. Okay, so that's kind of where we are. You've touched on rental, on the rental growth aspect, but what are we going to see? Well, on Thursday, as well as obviously the Granger results, we are also do have an autumn statement. Okay, there are actually a lot of results out this week for the quoted property sector, so it's a really interesting time. But we have also got this autumn statement. I think we know broadly that it's going to be one of austerity. Rents are going up. What's the Granger take? Are we going to see, how are you managing those rents? How is, the dilemma between rental growth and being a responsible landlord?
Yeah, a great question. And I think in build to rent, you are, and in any environment, you have to remember one thing: you're renting to people, not businesses, and you have to think very carefully about that balance. And it is in your interest in the long term to think carefully about that balance between managing your rents, managing the humans in your buildings, making sure you've got the right consumer data so you know who is in your buildings. People experience, we all talk about inflation at 10%. That means a lot of different things to a lot of different people. So you've got to understand that. There's no point putting rents up at silly numbers and then having a load of voids come through, because voids are extremely expensive and inconvenient. And in reality, again, and I think this goes for most of the platforms, we're all trying to build brands. We're all trying to build something different that makes people think very positively about our sector. And so you're having to balance all of those things.
Yeah. Michael, do you want to just...
Yeah, I mean, he nailed it, right? It's a people business about what we do as operators, right? And that people part and relationship extends. I mean, you couldn't have said it any better. And just to expound upon that, it's how you treat your staff during these challenging times. They themselves are working in the building right now, and they're worried about their own futures and where they're living. How are they going to react? As we as operators, we have to give them and help them get that confidence, because when they engage with that resident who's also feeling that way and concerned right now, then that's going to come through as it reflects on your brand. So as operators, you got to focus on your people at this time, and by extension, you also are going to focus on those relationships with your residents. And there's several steps that we as operators need to take now during these types of times to make sure that you're protecting yourself for how things come through on those renewals. And that goes back to being, like you said, that responsible landlord. You can't stress that enough at this time.
Okay, so let's just stay on, before we come back to Polly, let's just stay on the occupational mode. So have we seen, as rents are rising, are you seeing any mode of occupational changes, any patterns to the types of tenants that you're attracting, or types of customers, that you're attracting, or how people are occupying the space?
Sure. I mean, to be frank, we still have a severe housing shortage. That's fundamentally where we're at, and I think you're seeing demand everywhere. We as a business, we build in city centres. If you build 1 and 2 bedroom flats in city centres, what do you get? 20 to 35-year-olds, professionals, typically with no children. But you also have to understand that it's not just them. But we're seeing it across the spectrum, and when I say that, I mean you have to provide rental property for those on low incomes, middle incomes, high incomes. It depends where you are. But I think in general, the market's seeing demand everywhere.
Michael, do you want to add?
No, he's right. It's market or geographic driven, right? What zone that you're building in, what area, neighborhood you're building in, really is going to drive that unit mix for the target demographic that you might be going for. But again, you have to kind of keep that in mind about where you're building. I think I'm always cautious of those generalized statements that says like, well, who are we targeting for the London market? Well, it's way more segmented to that, and we see this in New York, we see this in other markets, and that where you're located, where you're building, drives that product type and service level that you're going to offer. I mean, 1 and 2 bedrooms, that's the 25 to 38-year-olds, no kids.
Okay, so in terms of the forward look, we're pretty confident that from a responsible perspective, there's more rent inflation to come to offset some of those headwinds. That's what I'm taking from that. I think we'll come back to the operational side and the cost side in a second, but I just wanted to bring Polly in to what's the capital markets forward look.
Well, the guys have nailed the biggest problem that's driving rental growth. So rents are up 12% nationally across the board, and that's 18% in London year on year. And that isn't slowing down. Well, it's kind of levelling off, but still double-digit rental growth on a month-by-month basis is difficult. The best thing that we can do to combat that is build more homes. And the supply and demand imbalance is absolutely acute. Since 2019, we've seen over 500,000 buy-to-let mortgage net redemptions. And over the course of the last 10 years, we've collectively, as an industry, managed to deliver 76,000 build-to-rent units. So the rental market is contracting. And that makes for a really strong investment case as to why we should be doing it, not just because the returns look great from the capital markets side, but also because we've got an obligation to kind of work out how institutional investment can really become or can fill this void of the housing market more structurally.
That's great, but in terms of people in and out, so there's quite a few people that are out at the moment, sitting on their hands. We're going to have an austerity type budget on Thursday. Does everyone wait for that and then on Friday morning wake up and say, right, let's go? Or is that, is there a pause until next year? What are we waiting for?
Well, you've drawn me on this question 3 times now, Jason, I think, so I better answer it. So I think that after the mini-budget, certainly there was a period of uncertainty. And I don't blame some investors for saying, maybe we just hold off a minute from investing hundreds of millions of pounds in a specific scheme or location. And it naturally fell in that point of the year where it made sense to say, let's talk in January. And there's a couple of schemes and processes and transactions which are well known in the market of being put on hold. What we've seen since then is kind of an interesting dynamic, which also isn't surprising, and that's saying, well, if I was one of 10 investors bidding on an opportunity in February, March and April of this year, well, why wouldn't, and I know that I'm long on the sector, I just might be short on timescales, why would I not be progressing investment strategies right now where the competitive landscape is maybe slightly more diluted and wait for the herd to return to that pack in the first quarter? And so we're referring it to the window of opportunity, or the WOO, and we're seeing...
I might steal that.
And so we certainly are seeing some investors that initially said, let's just wait, saying, actually, let's not wait. That doesn't make sense. Let's see what we can do right now. Why developers, the construction market and industry are all aware that we're being pushed and pulled from multiple angles. And several investors that had reportedly kind of put on hold their acquisition strategies have returned to engaging quite fluidly. Now, I don't think that will lead to capital committed in the next 6 weeks. We know how long it takes to get deals done in this sector. And the other point, which has been a really interesting part, and you're going to ask us on predictions in the future, is the fact that American investors that are prolific in multifamily investment in the States, and some Nordic investors and investors across the US that have, across continental Europe, that have had a bigger retrading or faster price adjustment because they were more established, mature markets, are seeing the UK as fundamental opportunity right now to invest, not least because some of the original players are pausing strategies, but there's a currency aspect, but also because we have the supply and demand imbalance, because we're going through a process of rental growth and discovery, that I think that the landscape for investment is going to change, and that there'll be several new investors into the sector over the course of the next 12 months, pulled over by all of those things, coupled with a lack of opportunity where in their normal investment geographies.
So a short woo.
A short woo, yes. Move now.
So I'm just going to pause there. Thank you, Polly. I'm just going to pause there. Are there any questions from the audience before I get on to the topic of rent control? No questions. We've got one at the back, please.
Thank you, Jason. Mark Prisk. 10 years ago, this sector didn't really exist, and it's great to see how it's grown. But I notice everyone keeps talking about brands, and I strongly support the notion of moving towards consumer-facing as a sector. How are the brands going to differentiate themselves over the next 5 years?
It's probably one for the sofa, isn't it?
That is a fantastic question. Okay, yeah. So yeah, Polly, you can probably take a break for a couple of seconds. So who wants to go first?
I'll jump on that one.
Brilliant.
Thank you. Nailed it, right? Hit the head on the nail about what this is going to be about, because a great mentor of mine once said, and this is in the New York market, you take an apartment, you put in a gym, you can call yourself a luxury operator, right? 4 square walls, heat and hot water, and you're done. You're a luxury operator. And that's the challenge that we're going to be facing now as we kind of market matures, things are coming out, people start offering it. The kind of amenity arms race, right? It's probably going to continue for a while, but then that's got to settle down as well, because there's just only so much space about what you can do. So then everybody starts saying, well, it's service, it's service, it's service. Okay, that has a lot of nuance in there about what that really means. You know, in other operating markets where I've been, you know, a really full service apartment means you've got somebody at the door, as well as somebody at the desk, as well as a package attendant that's handling all your parcels going up to your unit. That's a full service building. But that can have different meanings as well. So I think as you ask the question, how are brands going to differentiate themselves? That's the real challenge that we as operators are going to face, about what it is that we can provide in these challenging markets that's going to set us apart in the eyes of that prospect as they go out looking for what are called luxury or, you know, full service apartments, flats.
Yeah, a fair question. Economists talking about branding. I think it's about steps. So I don't think we're going to get to a point in the immediate term, say next 5 years, where people say this brand does this or this brand does this. I think in the immediate term is, let's get to the point where consumers look at us and say, that's a good living brand. They will look after me. I'm safe there. My house will get repaired. And I think if we get to that point of a certain level of service ascribed to this brand, and people will say there are 5 or 6 brands and they all do X amount of service, let's get to that point, come back in 5 years, and then we'll see where we go from there. But I think it's kind of steps.
Awesome, thank you. Any more? Another question, fantastic. Thank you. Just down the front, please, to your left.
It's just a yield question, Jason.
That's why I'm glad I'm the chair.
Is that me? Right.
No, let Dom answer the question.
What was the specific question?
How much are yields moving out as it currently stands, and where will they settle? What's your prediction over the next 12 months, please?
It's a very difficult question to answer. I mean, the transactional evidence that we've seen in the last few weeks would arguably suggest that, and it's mostly forward funding, right? And forward funding yields are very opaque anyway, because it depends on a very specific underwriting, which isn't actually transactional or based on an income stream. And so I've had yields of deals that I've been involved in quoted back to me with a swing of 50 basis points in every direction, and no one can say otherwise. And then what we've got is not the churn of operational assets because of cladding issues and because of and various different EWS1 related hold-ups, means that we haven't got a whole deck of comparables we can point to say definitively yields are doing this right now. I would say that on development in particular, which is the part of the business I look after, yields probably have moved already, and they've probably not moved by a massive amount, 25 basis points potentially. But the really important point is that underlying capital values on a pound per square foot have held. And that's because the perceived day one untrended rental underwrite has moved because of this unprecedented level of rental growth that we've seen. So if a deal's still holding up from January from June to now, for example, and we're 5 months on, actually that's probably been a 25 basis points move in yield if you keep your price consistent. And what do I think it's going to do in the future? Look, I think that like 75% of deals are in development space. Construction costs maybe not as bad or not as negative a position as they were at the beginning of this year. But there's not many levers you can pull to still ensure that at least these housing ensure the delivery of build to rent. And focusing on how we do get there is a really important part of that. And so I think that yield underwriting will move. Jason, what do you think?
I agree with whatever Savills say.
First time for everything.
No, I think the really important point you made is about looking at capital values. So looking at the whole equation rather than just purely focusing on yield. I am now going to move on very, very quickly to rent controls. How are you planning for this?
Favourite subject. The reality is that regulation is not necessarily bad, and I think if we look around the room, we all welcome regulation that makes people's homes a better place to live. And if you look at some of the statistics going back, the PRS sector has not always done that. So there's a reason why this comes up as a subject. I think, and we look at this a lot, the evidence from around the world is that rent controls produce two things. They produce an insider-outsider market. So if you're a market insider and you've got your rent-controlled flat, very good. If you're a market outsider, your rental goes up, mobility declines, it affects productivity, and it's generally not a particularly good thing. If you are someone that makes this argument that I'm making, you also have to back the fact that if you believe it's not going to produce good results, then in the long term, you're going to get a rebound from that anyway, because fundamentally a government will have to roll it back. And the reality is that rent controls, which set rents below where CPI, wages, whatever metric you care to use, if that kind of thing comes in, what happens? Supply goes down, or supply does not come through at the rate we need it to come through. And what I mean by that is that it's not just in a general sense, but supply has to be the right quality, we have to put it in the right place, and it has to match the household structures that people want to form. Yep. We're not supportive of rent regulation.
Thank you. I'm going to move on, because Michael, you were kind of nodding furiously about that.
Just that he was referring to kind of the supply issue, which you're already struggling with in this particular market, and as rent regulation comes in, that supply issue continues to drop even more. It creates an even challenger town.
Thank you. Polly, I know you've been doing a lot of the talking, but we've obviously just had a bit of an event in Scotland as far as rent control is concerned. What happened to the investment market there as a result of it? Has anything happened there?
I don't think any deals have closed since the announcement, I think that the care with which rental growth controls need to be implemented, if they are to in England, probably needs to learn some lessons from how not to do it in Scotland.
And worth pointing out that England's population has grown far faster than Scotland's. So the supply issue is far more pronounced here.
Yeah, so I think that is probably a message that is, if there is to be rent control, that is how not to do it, because it has obviously completely turned off the tap of much needed in investment. I've just got a question down the front which I'm assuming is on rent controls. I'm going to move on pretty quickly from rent controls in terms of timing.
So I'd like to link, so it's Peter Cosmatatos from Crufts Europe. I'd just like to link rent controls to ESG, which it's interesting that no one's mentioned in that context. In the pandemic, we saw that the government didn't care whether a moratorium on commercial rents and enforcement made economic sense, whether it was economically necessary. They introduced it, and it was good politics, short term, because it allowed the government to present itself as giving something to small businesses suffering on the high street, even though the government wasn't giving anything. It was landlords that it was requiring to give up a certain amount of control and short-term income. There's a very, very similar policy case for rent controls. A government that's forced to impose austerity and tax increases during a cost of living crisis can present itself as doing something for the little guy by imposing rent controls, which doesn't cost the government anything, near term. Now, I accept that longer term it's not a sustainable policy, the economics don't make sense, you create supply shortages and problems for the outsider. But isn't there scope for the industry to try and get ahead of this and present itself as responsible and having a social agenda as part of its ESG policy and imposing some sort of, loudly trumpeted voluntary restraint in rent control?
I think that's a completely fair point. Completely fair point. I suspect that probably it might not be. I don't know, Thomas. Do you want to answer that? Is that something you really can? I mean, as a quoted company with your results on Thursday.
I mean, look, when we develop a new building, we do everything we can to make it as environmentally friendly as possible. I think I stated earlier, when we deal with rents, we're not trying to put up rents as much as possible without regard to the humans that live in those buildings. So, to defend the sector a little bit, I think this sector puts on a good face to kind of push back on what's being said, and we have to live with that risk. And we do a lot on an ongoing basis. When we have voids, we put tenants or the void unit onto renewable tariff, and we hope the tenant keeps it. So you can do what you can, and any slowdown in our strategy, of course, is we develop new, very friendly buildings. Some of our older stock tends to get moved on to investors for whom that product is suitable. But yeah, it's.
So thank you, Peter. I just want to move on to advice for what people or what the money should be doing to, some of these headwinds. They're going to, increase costs. People are going to want pay rises. What can the operators do? What can the owner operators do to make themselves more attractive to the types of money that Polly says is going to be arriving in the new year?
I think in times like this right now, it's always focusing on the big three for operating expenses, right? So that's your utilities, your staffing cost, and then your MRO, right? All your maintenance, repairs, and operations costs and things of that nature. So wherever you can to get as energy efficient as you can, because that's, as we know, has gone up considerably, you have to manage that particular part. Now, staffing, this is one where personally I never pull back on in times like this, because as I noted earlier, it's a people business. Your staff and those touch points that they have with your residents are a key part about how your residents perceive your product in the marketplace. And if you're suddenly pulling some string or working on your staff levels or adjusting that in some capacity, that's going to translate over to your residents' perception of service, which will impact you on the long run. So you've really got to invest in your staff during times like this. And then when it comes to MROs and things of that nature, it's back of house supplies that you need to focus on, not that kind of front of house cost. Again, don't do something that's going to impact your perception of service to your residents. It's focusing on the things that are back of house. If in the past you'd been running monthly socials that had, fine cheese and French wine, and now you've moved on to Tesco biscuits and box wine, they're going to see that, and you got to watch it. But that back of house cost, things that aren't resident or on stage, that's where you can really aggregate, look out for those expenditure adjustments, and really, really, really get stringent on perhaps on your vendor bidding and things of that nature to watch your OpEx. And when you can show that type of professional management, then that makes it attractive whenever those woo opportunities start coming along.
Yeah, just to pick up on Michael saying, and I think that what you need to be very careful of is this isn't a purely cost-driven sector. So if you view it as let's cut costs to the bone as much as we can, let's try and make it as competitive as you can, you'll get slightly unstuck because your tenants have expectations. And a second point, that inflation's not going to last forever, and we could talk about the subject forever, but it really isn't going to last forever. And people remember what you did during a very short period of inflation for a much longer time that it impacts you. And just to kind of pick up what was Peter saying, you also have to remember that engaging in kind of total cost cutting doesn't always chime with the environmental agenda. So again, you've got to balance out all your different responsibilities and stakeholders.
Thank you. So moving on to the kind of money side. So, Polly, are we going to see, you mentioned about new capital maybe coming in early next year. Are we going to see any distress in this sector? You're talking about windows of opportunity. Is for those who are either entering the sector, there's going to be a greater degree of opportunities, or?
Distress, I think, is unlikely to present itself in build-to-rent assets that are under construction or already kind of capital secured for them. Where you might see is alternative developers turning to the sector, or, delivering open market sale product, but turning to resi for rent, worried about the volume of new home sales that they're likely to achieve. I mean, people always think that happens, and we didn't see it during COVID, so I can't guarantee that we will see it. But there is certainly the opportunity there. Certainly in a slightly more liquid market, I think that there'll be greater opportunity for parties to work together and come up with more creative deal structures that might distribute returns a bit more, which might look a bit more favourable, or might see developers taking on a greater level of risk.
And tips for winners and losers?
So winners and losers.
Either by geography or subsector?
Well, geography is difficult because every city is suffering with an undersupply. So I think the greatest acute movement of available properties in the UK is Newcastle at the moment, and second London. So there's kind of no rhyme or reason. I think that everywhere that's delivered a cross-sector market segmentation of a variety of different products into the market, like take Manchester or Birmingham, every product from the high end to the mid-market has performed very well.
Thank you. I think we're pretty much out of time. I'm going to say thank you very much to the panel, but just a quick summary from me. I mean, there's a big people aspect to this in terms of looking after your staff, looking after your residents, in terms of for the protection of income. Yeah, look at your costs, but it's probably not cutting them to the bone. We didn't really get into sort of that inflationary kind of staff cost, but that we could talk about this all day. There is a window of opportunity. I'm not going to steal the woo, but it feels as if it's quite short because there's more equity coming. Brand differentiation is important, but it's that safe feeling for residents, and there is a potential opportunity for the sector to sort of steal the march on rent controls and treat it as a positive thing. Rather than a negative if done in the right way. But thank you very much to the panel.